Good evening. I hope you're doing well. The news flow from the US markets has been negative. There has been an increase in the inflation by about 30 basis point from 3.15% to 3.48%, and the market is nervous, or at least the news commentators say that the market is nervous that this rise in inflation could delay the process of lowering interest rates. Consequently, the US market has reacted, and as we speak, Gift Nifty is trading about 300 points lower. This movement on a holiday, on the day when there is no trade session, uh, sets us up for the day tomorrow, wherein it is very reasonable for any trader to expect a gap down in the market by about 250 to 300 points. And the question is, how do we plan for the day ahead? In that context, today I thought that because we are seeing the index, which has just created a new life high yesterday at 22,775, is today embracing a potential 300 point fall for the trade session coming tomorrow. Since the index is at a new life high, it is obvious that anyone who is following trend or any directional system will have at least some, if not all, exposure on the long side. So, therefore, the impact will be felt by almost every directional trader in the market tomorrow. So, let's begin. We can clearly see that in this chart, the market, which was trading at an all-time high somewhere around 7th of March, having created a high of 22,500 plus, consolidated for approximately one full month till the 1st of April. And in the process of consolidation, we had established in the previous video, we could see that the market has created a sort of a cup and a handle pattern. So here, so the idea is that when the market consolidated between these two highs, which spanned about a month, the market created irregular lows, which means the low created was lower than the previous low, signaling a range. But in this range, it formed an obvious visible pattern, which was a saucer. And subsequently, we can see this channel here, the market formed a handle. And consequently, this region here, somewhere, that is the region right below the handle, becomes the area of support. Now the question is this actually a pivotal low? We can clearly see that the pivotal low is at 21,700. So logically, anyone who is long positionally should ideally be having a stop loss of 21,700. But the advantage is, because of the occurrence of this pattern, we need not consider this low of 21,700. And in the immediate short term, a stop loss of 22,250 is quite reasonable. And the reason for exit would obviously be that there is a pattern failure. In the event of a pattern failure, this is how the market will most likely look. So I'll just push this forward, try and zoom into the chart here. So let's just assume that the market has to hit the 22,250 mark. Then in such a case, the market would open lower, approximately 300 points, which would mean that the market should open at around 22,450. And from here, it should continue its move downward and either close here or at least create a theoretical low here. And in such a case, we will see that we should be exiting any position on grounds of pattern failure. But more importantly, what we will actually note is that pivotal lows, that is pattern pivotal lows here, would have been broken, and the market would have once again created a sort of a lower bottom after creating a higher top, which would signal another range. While we are obviously seeing a pattern with a clear target of 23,725, and we are expecting a gap down in the open tomorrow, it is not necessary that the stop loss will trade. However, a trader has to plan the exit of positions at 22,250, not with the idea of going short on the market, but simply with the idea of uh, following the process of a pattern. That is, if the pattern is violated, then the trader has to exit. But the question is there no justification to be long? So here one we will see in the hourly, we will see that, zoom out a bit. This is the saucer pattern that we are referring to. This is the handle that was occurred, and so the handle is better placed here. And this is the low, the pivotal low after the handle that was created. And therefore this black line is marking our stop loss. Now, if the index has to come around 400 to 500 points lower, then in such a case, the question is, do we buy the index in the first attempt? Now, in order to buy the index, we need to answer the question, is the index selling or is the index oversold? For the index to be oversold, we obviously need some oscillator. So for example, I'll just take RSI and I will choose the setting as 5 because 14 is too slow, and since the scope of assessment is just this chart, we will increase the sensitivity. So what we will be seeing is that from a highly overbought position, the market will be gapping down. And since our view on the weekly has already been to be long on the market, the gap down on the market should ideally not invite any significant trade from the directional trader. Because when the market was previously oversold, which was happening around the base of the saucer, the trader would have gone long, and this gap down means the positions that were created here need to be evaluated if or not they have to be exited. If the market continues its move lower, then in such a case, the oscillator will come down. However, it will still not be oversold, where oversold needs to be a level below 30 in the case of RSI. So therefore, such a trader will have to wait till the market becomes oversold. In other words, whenever we are looking to buy a dip, we have to factor two things. One is the dip in price and the period. That is, it has to go through a price and a time consolidation. The idea of using an oscillator in your process of buying indicates that you are factoring in at least a period. So by setting a period of 5, at least a 5-day period of consolidation at a particular support level before you take a decision to buy. And the reason for having an oscillator on the daily charts and taking this decision is because the major event that is very applicable to our markets is the election result, which is scheduled to happen sometime in June. So therefore, the market could comfortably consolidate for a long period in between, giving several potentials buying opportunities on stocks. We will have to be on the long side direction because actually we are seeing this kind of a structure on the weekly and we are not seeing any weakness at all. So we have to be on the long direction, and the correction below will force us to evaluate any positions that have been created in the last 10-15 days, and will release funds in order to add positions once the market proves a support after a certain period of consolidation. Now, if the trader is a day trader, then in the event of a gap down, the day trader will immediately see that the oscillator would have gone and dipped below 30. So the market needs to gap down by 300 points and then sustain there for at least an hour or so for the charts on the hourly for the oscillator to trade below the 30 level. And once this trade below the 30 level happens, then such a trader will use another time frame, that is a 10-minute chart or a 15-minute chart, in order to identify a break. So we need to visualize that the market from this 22,750 has opened at, say for example, 22,450 and then continues lower. Now, this is happening on the 15-minute chart. We will ignore the RSI because once it is lower and the RSI is oversold on the hourly chart, then from that point we are simply looking for the first break on the upside on the 15-minute chart, and then or a potential pattern which could happen in this fashion. So in other words, if there is a day trader, the day trader is likely to see a bullish market on the daily become oversold on the hourly, and bullish pattern formations or oversold conditions with bullish confirmations on the intraday charts could invite trading action from the day trader. The positional trader, the trend or the swing trader who uses the daily and the weekly for the trend time frame is most likely not going to react and is only going to take a decision on the existing positions that such a trader may be holding. Even if long positions are added, they will be very, very low value in relation to the overall account, because there could be a stock that you could be seeing at at a significant support relative to the market. So for example, if you take a look at a stock like Nestle, we are obviously seeing the market trade at its all-time high, and we are obviously seeing that Nestle has an all-time high approximately 10 to 15% above its current values. We are also seeing that the stock is in a long range, and I mean, if you first evaluate the trend on the weekly, there is no ambiguity that this is a bullish trending stock. This is the higher top, this is the higher bottom, and this is a period of consolidation. In this period of consolidation, we are seeing a bullish harami and a confirmation on Wednesday. It is logical that a dip in the intraday time frame here around these levels is going to invite trading action, because such a stock has given a bullish confirmation on these levels already here. So we are seeing two, just here highlighting. So you can see this is an inside day candle, this is again an inside day candle, and we have seen this occur at around 2500 levels consistently. We are seeing a huge cluster support at 2450. So we are approaching a region of very strong support for a stock like Nestle, which is structurally bullish trending and has been consolidating or has proven this area of 2450 for a very long time. So a better diagram could be something like this. Just try to find a parallel channel, and this region here has been tested from 2023 October. So it has proven for 6 months to hold. So logically, buying in this support zone makes complete sense. So in other words, when the market gaps down, since we are discussing Nifty chart, so when the market gaps down, it is not necessary that we will be buying the market, but it is possible that certain market constituents are offering an opportunity to buy because they are coming very close to their positional support levels. And even though the market gapping down would weaken momentum and threaten a potential range, the trend will not reverse, and therefore the bias will continue to remain on the long side. The idea of the video today was to share the thought process as I see it. I hope that this benefits you in some way in your overall preparation process. I wish you well. Thank you.